Mastering the Marubozu Gapping pattern involves understanding its role as a continuation pattern within the context of stock trading. The Marubozu Gapping pattern is recognized by its distinctive gapping Marubozu candles, which are characterized by a wide price range without shadows, indicating that the opening and closing prices are also the high and low prices for the day. This pattern suggests a strong continuation of the current trend, whether bullish or bearish, following the gap. To effectively apply this knowledge, one should look for these patterns after a significant trend has been established. A bullish gapping Marubozu indicates a strong buying pressure where the price opens and continues to rise throughout the trading period, suggesting the trend is likely to continue upward. Conversely, a bearish gapping Marubozu signals strong selling pressure, hinting at a continuing downward trend. Key to leveraging this pattern for successful trading strategies is the ability to identify these candles early, understand the market sentiment they convey, and make informed decisions about potential entry and exit points. Monitoring volumes during these patterns can provide additional confirmation, as high volumes often reinforce the trend's strength. In summary, mastering the Marubozu Gapping pattern demands a good grasp of technical analysis fundamentals, keen observation skills to spot these patterns as they form, and the ability to interpret them within the broader market context to make strategic trading decisions. The two black gapping is a technical chart pattern commonly seen as an indicator of a continuing downward trend in a market. It is named for its appearance, which consists of two black, or in modern terms, red candlesticks that gap downward from the previous trading sessions. These candlesticks are characterized by their opening prices, which are lower than the lows of the preceding days, indicating a strong bearish sentiment. This pattern typically emerges after a noticeable downturn in the market, suggesting that the price is set to decline even further as sellers outpace buyers. Introduction to the concept involves understanding the shadow of the two black gapping, which metaphorically describes the potential influence or foreboding presence this pattern can have on future market movements. When identified, this pattern serves as a warning to investors and traders about the continuation of a bearish trend. It alerts them to brace for potential further declines in price and consider adjusting their investment strategies accordingly. Recognizing this pattern involves not just noticing the two gapping down candles, but also understanding the broader market context, including trading volumes and preceding price action, to accurately forecast potential future movements. Identifying the two black gapping pattern involves recognizing a specific formation on the stock chart that signals a potential continuation of the prevailing downtrend. First, let's delve into the formation of this pattern. It starts after a noticeable downtrend, indicating the market has been bearish. On the next trading day, the stock opens with a gap down from the previous day's close, which means there is a visible space on the chart where no trading took place. This gap is essential in forming the two black gapping pattern. The key characteristics include two consecutive black or filled candles. These candles show that the stock closed lower than it opened, reinforcing the bearish sentiment. The crucial aspect to note is that there are no overlaps between the candles and the gap remains unfilled during this period. For traders and investors, identifying this pattern is a signal to possibly brace for a continuation of the downward trend. The rationale behind this interpretation is grounded in market psychology, with the gap indicating a strong sell-off and the lack of buyers' interest to push the price back up serves as a confirmation of bearish momentum. By recognizing the two black gapping pattern, investors and traders can make informed decisions on whether to hold, sell, or explore short selling opportunities. It's a testament to the importance of understanding market patterns and applying technical analysis to guide trading strategies. The two black gapping pattern is a bearish continuation pattern found within financial markets. This pattern signifies that the current downtrend in the market is likely to continue. It begins after a noticeable downtrend, capturing a moment where the market gaps down and opens at a lower price than the previous close. For 2 consecutive days, the price opens lower, creating a gap from the previous session's price without filling it. This gap is a visual representation of the bearish sentiment, indicating sellers are in control and buyers are retreating, causing the price to drop further. Understanding market sentiment involves deciphering the collective attitude of investors towards a particular security or the market as a whole. When the two black gapping pattern appears, it reveals a strong bearish sentiment, suggesting that investors are pessimistic about future price prospects. This bearish outlook is reinforced by the presence of the gap, which shows a sudden and strong shift towards selling. As prices continue to open lower and no immediate attempt is made to fill the gap, it becomes clear that sellers dominate the market, pushing prices down. Investors observing this pattern can infer that the market's downtrend is not only intact but may intensify. Recognizing these patterns and interpreting market sentiment correctly are crucial for making informed trading decisions, allowing investors to align their strategies with the prevailing market trend. The two black gapping pattern is a key indicator in technical analysis that signals a potential continuation of a downward trend in the market. It first appears after a significant drop in price, showcasing a gap between the previous day's low and the next day's high, with both days closing lower than they opened. This creates two black or red candles on the chart, side by side, with a noticeable gap between them. The essence of this pattern lies in its ability to hint at investor sentiment, suggesting that the selling pressure is not only persistent but likely to continue. It is formed under conditions where investors are in a state of caution or pessimism about the future direction of the asset's price. Recognizing this pattern is crucial for investors and traders as it helps in making informed decisions about whether to sell off their holdings to prevent further losses, wait for more confirming signals, or explore short selling opportunities. Overall, the two black gapping pattern is a dark harbinger in market analytics, pointing towards an ongoing bearish momentum that might not reverse soon. To understand the concept of two black gapping, a bearish continuation pattern, it is essential to first grasp what this pattern signifies in the context of stock market analysis. The two black gapping pattern is observed on stock charts and is considered a signal that a current downward trend in the market is likely to continue. This pattern involves two main elements. First, after a period of downtrend, there is a gap down in price, which means the stock opens at a lower price than its previous close. Following this, there are two consecutive black, or in other terms, red candles. These candles have opening and closing prices that are lower than the preceding days, reinforcing the bearish sentiment. Confirming the signal is a crucial step to ensure that this isn't a false alarm. Several methods can be used to confirm the two black gapping pattern. One primary method is to look for an increase in trading volume on the days of the gapping down and the formation of the black candles. High trading volume suggests strong investor sentiment behind the price moves, lending credibility to the continuation of the downtrend. Another method of confirmation is to observe the price action in the days following the formation of the pattern. If prices continue to trend downward without filling the gap created by the gapping down, this can serve as confirmation of the bearish trend continuation. In summary, the two black gapping pattern signals a continuation of a bearish trend, characterized by a gap down followed by two lower closing black candles. Confirming this pattern involves looking at trading volume and subsequent price actions. Understanding these concepts can provide investors with insights into potential market movements, allowing for more informed decision-making. The reliability of the signal in the context of the bearish continuation pattern known as two black gapping depends on various factors. This pattern occurs after a price decline and indicates that the downward trend is likely to continue. It starts with a gap down from the previous day's close, showing strong selling pressure. To assess the reliability of this signal, traders often look for confirmation in subsequent trading sessions. Confirmation can come in the form of further price declines or a continuation of high trading volumes. High volume is particularly significant because it suggests strong market consensus about the decreasing value of the asset, strengthening the signal's reliability. It is also important for traders to consider the broader market context. The signal's reliability can be influenced by prevailing market conditions such as market sentiment or economic announcements, which can impact trading behavior. Moreover, traders commonly use technical indicators in conjunction with the two black gapping pattern to gauge its reliability. Indicators like moving averages, relative strength index (RSI), or the moving average convergence divergence, MACD can provide additional insight into market momentum and help confirm the pattern's bearish signal. In summary, while the two black gapping pattern is a powerful indicator of bearish continuation, its reliability is not absolute. Traders must consider it within the broader market context, seek confirmation through subsequent price actions and trading volumes, and use complementary technical indicators to make informed trading decisions. The two black gapping pattern is a bearish continuation pattern that signals the potential continuation of a downtrend in the market. It is identified by a gap in the stock price that occurs after a noticeable downward movement. The pattern consists of two consecutive black, or in modern terms, red candles that open below the previous low, further emphasizing the strength of the bearish sentiment. In synergy with technical analysis tools, the two black gapping pattern gains additional validity and can provide more precise entry and exit points for traders. For instance, incorporating volume analysis can strengthen the signal given by the two black gapping pattern. An increase in volume during the formation of the pattern indicates a strong bearish sentiment, making the continuation of the downtrend more likely. Furthermore, using moving averages can help to identify the overall trend context more clearly. If the pattern forms below a major moving average, it reinforces the bearish outlook. Support and resistance levels also play a crucial role. A two black gapping pattern forming near a strong resistance level may suggest a significant rejection of higher prices and the likelihood of a continued descent. In summary, while the two black gapping pattern itself is a strong indicator of bearish continuation when it is analyzed alongside other technical analysis tools like volume indicators, moving averages, and support and resistance levels. Its predictive power can be enhanced. This holistic approach enables traders to make more informed decisions with a clearer understanding of market dynamics. When discussing the two black gapping, a bearish continuation pattern, and focusing on navigating pitfalls, it is critical to understand the essence of the pattern and the challenges it presents. The two black gapping pattern is a technical analysis indicator that suggests a continuation of a downward trend in the market. This pattern appears after a notable decline in the price of a security and is characterized by a gap down from the previous day's close, followed by two black or red candles with lower closes. These gaps and candles indicate a strong selling pressure, suggesting that the price may continue to fall. Navigating the pitfalls associated with this pattern requires a keen eye and an understanding of certain precautions. One major challenge is distinguishing between true continuation signals and false signals that might indicate a reversal or a temporary pullback. To effectively navigate these pitfalls, investors should consider the following. First, look for confirmation in the trading volume. A genuine two black gapping pattern usually comes with an increase in trading volume, as the drop in price is backed by a significant number of sellers entering the market. If the volume is not noticeably higher, the pattern might be less reliable. Second, analyze the broader market conditions or the context within which the pattern appears. A bearish continuation pattern is more likely to hold true in a predominantly bearish market. If the overall market sentiment is not in alignment, the pattern's predictive power weakens. Lastly, setting stop-loss orders can be a prudent way to manage risk when trading based on the two black gapping pattern. Since no pattern is foolproof, a stop-loss order can protect against large losses if the market does not move as anticipated. Understanding these nuances helps investors and traders navigate the complexities of bearish continuation patterns like the two black gapping more effectively. Remember, while technical analysis patterns offer valuable insights, combining them with other analysis tools and understanding market context greatly enhances decision-making accuracy. The two black gapping pattern is an indicator that may help predict the continuation of a bearish trend in the market. It consists of a sequence where after a considerable price decline, there is a gap, followed by two black or, in modern terms, red candles that both open and close lower than the previous day's close, signifying that the selling pressure is still strong. In strategic applications, this pattern is often used by traders to confirm the presence of a bearish sentiment in the market, providing them a sign that it might not be the right time to enter into long positions. Instead, they might consider short selling or waiting for a more favorable entry point for long positions. Recognizing this pattern early can also help traders set more accurate stop-loss orders to manage risk, as it gives a clearer indication of where the trend is likely heading. For instance, upon identifying a two black gapping pattern, a trader might place a stop-loss order just above the gap or the high of the first black candle to minimize potential losses if the market direction reverses unexpectedly. This kind of strategic application relies on understanding market psychology and price movements to make more informed trading decisions, ultimately aiming to protect investments and capitalize on the prevailing market trend. It's crucial to combine the observation of this pattern with other technical analysis tools and indicators to increase the accuracy of predictions, as relying solely on one pattern could lead to misinterpretation of market conditions. 2. Black gapping is a bearish continuation pattern observed in the financial markets. This pattern is characterized by a specific formation on a stock chart that typically signals the continuation of a downward trend. The pattern emerges after a significant drop in price and is identified by 2 consecutive black or red candles, which open below the previous day's low with a gap between them. These candles do not fill the gap, indicating strong selling pressure and a lack of buyers at higher levels. When exploring variations of the 2 black gapping pattern, it is important to understand the nuances that can affect its interpretation and reliability. Variations can occur in the size of the gap, volume during the formation of the pattern, and the subsequent price action following the appearance of the 2 black or red candles. For example, a larger gap may suggest a stronger bearish sentiment, while higher volume during the formation can confirm the strength of the pattern. Additionally, a quick recovery that starts to fill the gap might indicate weakening bearish momentum and should warrant caution. Understanding these variations is crucial as they provide deeper insights into market sentiment and can help in assessing the potential for continued downward price movement. Recognizing these subtleties enables better decision-making for traders and investors, aiding in the formulation of more effective trading strategies around bearish continuation patterns like 2 black gapping.